Good evening. It's January 23, 6:41 p.m. Welcome to episode 31. Good evening to you, Wawi.
Good evening, Mark.
How are you?
Doing good. Babysitting.
All right. Family man. And also you're recovering, right? Everything okay, Wawi?
Yes, I'm recovering from COVID. So
Yeah.
doing well.
Well, it's good that you have the vaccine and hopefully that helped.
I think it helped a lot because it took me just a few days to recover.
Wow, that's amazing. When you first told me, I was really concerned, and it's good that you're able to hop in, rain or shine, whatever you feel, you're always available. Thank you, Wowie, and I appreciate your time joining us today in this podcast. And good evening to our listeners. I hope everyone is safe and healthy. This is your host, Mark Yu,
Wabi Santos.
and welcome to the Mark Yu and Wowie Show. So this show is, for disclosure, is made for sharing purposes only and not to be considered investment advice. We record once a week. I and Wowie are both physical therapists here in the USA with same passion and interest in researching and investing our hard-earned money in the stock market. To our co-workers in the medical field, thank you guys for your hard work. So if you guys missed our previous episode, it was a blast. We had a special guest join us. His name is Bernard Sanga, and he discussed his expertise in the real estate market. So far, Mr. Sanga has been able to gather at least 15 units, commercial properties, as well as being able to handle them um, through property managers. And he manages some properties by himself too. If you want to listen and learn more about starting your career in real estate, you might want to check that episode out, episode 30. So for today's episode, we're going to start off with an amazing data where Nasdaq, or aka the top, internet companies here in the USA, is now down 11% so far this year and is poised for the worst start since 2008 financial crisis. What do you think about this, Wowie?
Yes, that's putting it nicely. I think we used the word carnage yesterday,
Carnage, yes.
Friday.
Bloodbath everywhere,
Red, dark red,
right?
bloody.
So as what we're gonna see in a little bit, we're gonna see how the indices have performed and some big tech as well. As I've kind of like rambling to myself this morning, and I shared into our investment group, I kind of noticed how bad it has been since even last year. While remember when we first had our couple episodes, we were discussing the bright minds in finance, like the geniuses of Robert Kiyosaki, Jeremy Grantham, and we've been quoting them predicting a potential collapse in the financial industry, even early as January as last year with Tepperman, as I recall. But now it seems like in hindsight, those scary words are coming to fruition.
Yeah, so it took a while for things to finally land us into the expected correction
Right.
about since last year or more than last year.
Mhm. It's quite scary because right now there are a lot of people being exposed to this market, and they haven't been quite as exposed throughout the downturns. All they have been able to experience is all the new all-time highs day after day last year. So
Yeah,
right now you can definitely sense the panic as we're going to go into a little bit. We're going to look at the weekly sentiments that we always bring up on this podcast.
yeah, there are a lot of newbies in the market,
Hmm.
and a lot of them have not experienced a correction,
Right.
and they don't realize that a lot of the quantitative easing
Hmm.
has taken a big is a big factor while why things are um, growing so fast in
Exactly.
yeah in 2020 and 2021.
Hmm.
There's no more QE or quantitative easing, and
Right.
there's a rate hike
Mm-hmm.
like in March.
So yeah, as for the layman, quantitative easing is like when Federal Reserve loosens the rates or charges less for banks and finance firms to take money or get into debt. So right now, the Federal Reserve is taking a different stance, as expected. Now that the economy is slowly recovering, or at least in a boom mode, as evidenced by data. Now that we have very high inflation, and they are forced now to do something to control the inflation, and that easy money has propped up valuations everywhere, not just in the stock market, but also in the real estate. And now we can feel it in our daily expenses, our gas, meat, groceries, all consumer products. So yeah, going back to this article by Market Watch, where Nasdaq on its pace to worst performance since 2008. They provided a very nice data sheet here and table indicating that actually January is now looking at its worst performance record for January, Nasdaq that is, since the Nasdaq's inception in 1971. Right now we're at negative 11%, 11.29%. It's the biggest losing January month since the index inception, followed by January of 2008, where it just lost 9.89%. So right now, it's not looking really flattering for most of the bullish investors out there, including yours truly, which I was looking forward to at least have the index kind of hold on its own. But getting trying to recall our past couple of months podcast, while we already have felt this type of wave coming because of like a lot of even small capitalized stocks or tech stocks have been already experiencing more than 50% drop, like which the likes of Zillow and let's just say fresh into mind is Peloton. Aside from personal or companies experiencing some hardships, but they've been slowly falling off, right?
Yeah, an ETF like ARC and
Oh yes.
Sign.
Mm-hmm.
Yeah. And a lot of these new growth companies like Upstart
Uh-huh.
and Hubmatic are also um, suffering from the the fear, the inflation fear.
Right. So it for me, as I've wrote in our messenger group this morning, it's like we felt it back in February of last year when the SPAC mania, well, the meme started it all actually, right? The
Mhm.
meme back in late January and early February, kind of like, it held its ground until mid last year. And then SPAC came to a bust starting February, and just kept falling. And then the IPO bust started somewhere in June, summertime to fall. And then now we're experiencing some crypto bust, and also some like you said, ARC, like those futuristic companies, genomics and all that, which don't have any profits to show, but a lot of promises ahead of in years later on, which now investors are kind of afraid of putting money into, now that easy money is slowly going away or slipping away, which we're going to see in a little bit with the financial conditions, if that is the case. And now we're seeing big tech companies being drilled down. um, Look no further than Netflix. Friday just dropped like crazy, just lost its altitude, lost billions in capitalization.
Mhm.
Stock dropped like 20% in one day. It's the biggest drawdown since recent times, I guess, couple since the COVID lockdown.
Yeah, so analysts are really scrutinizing
Mm-hmm.
every detail of the earnings report. So they got Netflix on their uh, subscriber number of subscriber. They were expecting like 28 million new subscribers,
Right.
but we got about 25 million, and
Uh-huh. In total, yeah.
for them to be convinced.
So they were short about 1.5 or 2 million subscribers, and they got thoroughly punished. And this
Mhm.
reminds me why we like back in June of last year, we were looking at big tech, comparing their earnings, Apple, Amazon, Google, all of these big guys, specifically Amazon, because Amazon is quite being like conservative in its projections. Nonetheless, Wall Street always hikes up its targets, and eventually Amazon doesn't meet those targets, and they experience some sell-off. So this coming week, actually, Amazon is gonna be reporting its earnings, and what's scary or what's something to look on is like more likely if it'll miss, then we'd probably further see some drawdown in its shares. So as a big component of the Nasdaq and other indices and other ETFs, once these sell-offs still continue, right now I think it's around 2,800. It was back in 3,400 not so long ago, but once the sell-off continue, I mean, it's going to be hard and challenging for some new investors to stick with the stock, right, Maui?
Mhm. Yeah,
Yeah.
so it's gonna based on your conviction now,
Mm-hmm.
so if you did your homework and you look at the financial data,
Mm-hmm.
the company that you're investing in, will grow in the future, and it's a good hold for the long term, then you're okay.
Right.
Right? But if you didn't do your homework, then you'll have second thoughts, and that might make you feel um, a little bit worried right
Right.
now.
Some scary thoughts. All right. Well, we're gonna jump on into our weekly segments, sentiments, and more. So first, we're gonna look at the American Association of Individual Investors sentiments. So right now we are just at 21%, a very low sentiment for being bullish. So not a whole lot of investors. 2 out of 10 investors in the USA are now thinking that the stock market will be down in the next 6 months compared to its last week's 25%, even lower. Just compared to last month's December 29, which was around 38%, where it was at its historical average. And obviously, people are jumping from the bullish camp, those who think that the stock market will be up, jumping to the bearish camp, which thinks that the stock market will go down in the next 6 months, to almost half. So almost half, 5 out of 10 investors are now thinking that the stock market will be down in the next 6 months. And if you're going to look at this interesting chart by Zero Hedge, the AAII, or American Associated Individual Investors sentiment, is now at its lowest in a decade, lowest in 10 years. So people are quite scared right now, as I would likely freely say. For the week's performance, energy is still at least the best performer, albeit negative at negative 1.2%. Worst performer, obviously, is big tech or technology, almost down 7% in just 1 week. As an index, like we said, it's down more than double digits. Year to date, technology is down 13%. 13% for energy. Worst start since 2008. Worst January performance since the index was made. And energy is the best performer. It's the only category or industry that's up. And it's not up by just 1%, it's up by double digits, 10.68%, reflecting the inflation, reflecting the reopening, reflecting the possible tightening of oil supply in the world. Uh, so volatility, as Wawi has introduced this earlier on, the volatility index is, look at this, it's almost doubled Wawi. 74% since the start of the year for the volatility of the S&P 500 index.
Yeah, there's a lot of fear in the market.
Right. Volatility reflects fear and uncertainty for sure. So I just found out this other volatility index, Huawei, it's volatility for the Nasdaq. So we have VIX for S&P 500. We have VXN for Nasdaq. For VXN, believe it or not, it's a little less volatile. So it just means at 60.9%, it's a little less volatile than the S&P 500, meaning that the Nasdaq sell-off hasn't been met with some upside reversals. So it has been just thoroughly going down slope since the start of the year, which isn't good for investors who would like to always see green in their portfolio nonetheless. And so here's the indexes performance as I would like to review every once in a while. So the worst performer are the small capitalized stocks, which consists in Russell 2000. So they're down almost 13% or 12.5%, 12.53%. They're um, at par with Nasdaq. Nasdaq now, which consists of big tech, is negative 12.5% as well. So no difference between the small caps and the big techs right now. Both are down in the dumps. S&P 500, 500 largest companies in the US, is down negative 8% for the year. The Dow Jones, which consists mostly of industrials, commodities, and the banks, is still down negative 6%. So they haven't been like saved at all. But if you're going to look closely at the ETFs of banks, banks are actually negative in as a batch or as a group is negative 0.9% since the start of the year, which, a pretty good buffer compared to the rest of the indices. And XLE, the ETF for energy stocks or oil companies, they're up 9% as a group. So we're going to look at closely the specific stocks. Netflix, of course, negative 33%. Personally, I have Netflix in my portfolio. Definitely quite felt that drop Friday. I lost almost half of my profits unrealized because I haven't been selling nothing with Netflix. I've been just holding since I bought it before. So 33% since the start of the year, 20% down just Friday, one day alone, followed by ARK, Kathy Wood's ARK Investments ETF, down 26.26% for the year. Tesla is down negative 21% since the start of the year. The Tesla as retail favorite, right, Huawei? It has been like always in in discussion.
Yeah, but come its earnings report, um, I've been following some Wall Street bets.
Uh-huh.
They're seeing that Tesla may be the next one to drop, according to these guys on WSB.
So they have more room to drop, they say.
Yeah, so
Oh,
we'll see.
right. So now next will be Amazon. We're jumping into the big tech right now. Amazon is down 16.3% since the start of the year. And take note, it hasn't reported its earnings yet. So we're not saying to short the stock, but just watch out this week because they'll be reporting their earnings. And as I can recall, since the banks already done with them with their earnings, like the big banks, JP Morgan, Goldman Sachs, Morgan Stanley, only a few of them came out in the green right after the report. And if any indication, Netflix is not a good sign since they were the first ones of the FANG stocks to report and they dropped like a hot potato.
Mark, can you check your microphone?
Uh-huh.
I have trouble hearing you.
Oh, sorry. Let's
I don't
see.
know if it. I thought it was just my system earlier.
Uh-huh. Well, It's connected, I guess. Can you hear me better?
Yeah, I can hear you, but the volume has gone down.
Oh, okay. I'm not totally sure how to do, but yeah, it's on loud volume, but we'll try our best. I'll just increase my voice.
Okay.
So, and then JP Morgan, like I said, one of the big banks is down 10% since the start of the year. Yeah, its strong earnings didn't help. One of the reasons why it's down is because it said that it has to allocate even more to cost or to expenses to retain its employees. So, they're paying big bucks for their Wall Street traders. And Google will be next. Look at Google, negative 10% since the start of the year. This company is also going to be reporting its earnings this week, which is one thing to anticipate for. Um, and then we're going to jump onto both Exxon and Chevron. If anything, these two are the wild outperformers since the start of the year. Chevron is up 6.4%, Exxon up more than 10%, double digits at 13.58%. So definitely oil has been able to perform very well so far this year, at least on this month. The fear and greed index for the cryptos looks like fear and greed in cryptos is now in extreme fear at 11. This compares to last week's 21. So it even fell down. So right now I pulled up this chart for its year to date. Ethereum is down, a cryptocurrency for proof, right, Huawei? They do business or they do transactions with proof model. So they're more energy efficient.
Yes. So
So,
they're moving away from Bitcoin because Bitcoin uses a lot of energy for
right.
proof work. So a lot of these um, developments, like Solana, Polkadot, they use less energy.
Mm-hmm.
They use Ethereum, so it
Oh, I see.
uses less energy.
Right.
But Ethereum is also having its own problem because it's trying to catch up with Solana and Polkadot because they're charging a lot of fees.
Uh-huh.
Um, so they're trying to develop Ethereum too, but
Mm-hmm.
so far it's been a slow process because they're making sure the system is secure.
Right.
So
Well, looks like Ethereum didn't escape the bloodshed. Nothing to make fun of, but I guess it's just down, really down compared
mm,
to its peers, down 31.7% since the start of the year, followed by BCH. Is that Binance coin or something? Down 30.4%.
I think
XRP down 24.9%. LTC 24%. Bitcoin negative 22%, 22.4. And for the positioning, this is from Bank of America. Positioning versus history for the month of January. Looks like people or fund managers are now heavily invested in banks, commodities, materials, stocks, cash, healthcare, industrials. They're a lot less negative, or they have moved out money from bonds, from tech, from emerging markets. So Nasdaq, 10% corrections. This is an interesting chart. Let me see. Yeah, I was able to pull this up. So according to its history, we are now down 14.3 since November of last year. If we're gonna look at its average downtrend or corrections since the great financial crisis of 0809, we're near the average of negative 15.2%. So average since everything has started is negative 19.5%, almost bear market territory. So right now we're at negative 14%. So there's still some more room of downturn if we're gonna follow through with with the average since since history, since it was inception, or what since it was made, since the index was formed, which is quite worrisome. But if you're gonna look at median, we're median meaning like 50% of all occurrences that Nasdaq experienced corrections, we're close to 16.6% at least, at 14.3% as of Friday. Lots of numbers there. Sorry if just just probably replay that part in case you weren't able to catch all of those numbers. But yeah, so looking at S&P 500, we're looking at worst month since comparison. So January 2022, S&P 500 is now down 7.7%. Sorry about the numbers, guys, but we just want to compare against history and where we are at. So history is not indicative of future performance, but it's good because the more you know, the better, at least in engaging the market. So S&P 500 in January lost 7.7%. It's the worst month since March 2020, or the COVID lockdown. The Nasdaq is negative 12%. It's worse since October 2008, which we already said earlier. The SPAC obviously is down. Renaissance IPO is down since they've been made, or the index fund has been made. So this is one data also that I pointed out in our small group chat this morning. The monthly net purchases of US stocks by individual investors have shot up like more than double since the lockdown. So back in 2018, 2019, buyers, investors in the stock market have probably spent around, in conglomerate or in summation, between 8 and 10 billion dollars. But starting the COVID lockdown, with the stimulus checks and people able to access the stock market using different brokerages, the exposure to the stock market by individual investors more than doubled, even tripled in some occasions. So since 2020, we've been averaging monthly more than 10 billion to even mid 20 billion dollars, even until recently. So the more people experience the sell-off, some people may not have the risk appetite to stay in the market, where in occasion that they have to, in order to reap the gains in the end, or the recovery in the end. So this is a chart from Bloomberg. So quite a drawdown, is just showing how bad it has been for Nasdaq since the start of the year. We haven't seen this since the lockdowns of March 2020. And also, as we have already repeated over and over, this is the worst start since the inception of Nasdaq. So for 2022, this is a nice summation of what to expect for 2022 from Refinitiv or Reuters. So the final factor for S&P 500, this is S&P 500, not just Nasdaq, for this year, 2022, are the earnings. So average earnings growth in the S&P 500 is typically in the mid to high single digits. So Refinitiv shows here a graph or a table that shows that 2022 is exactly what is shaping up to look like. So this is a good sign. As we have remembered, while we like couple of podcasts ago, we played a clip from Tom Lee, the ever bull Wall Street, Wall Street, I would say,
Bull.
guru. Yeah.
He's
Yeah.
always bullish.
He's always bullish, and he said the first half of this year is going to be quite a challenge, and then later on this year we're going to see a recovery, even probably all new all-time highs again. So for Refinitiv, this is Reuters. They say for the first quarter of this year, we're going to see 7.6% increase in earnings, which is good. Second quarter, a slowdown to 5.2%. Quarter three, 7.4%. and look at quarter four, always is the strongest quarter of the year because of the holiday spending, 14.3%. So it does look like it's gonna be like a typical year, not a crazy wacky year as 2021 has been because of the reopening stuff and companies delivering more than 200%, 100% earnings. So the bottom line is for Reuters, it said overall earnings for 2022 are likely to be in the mid to high single digit numbers, about in line with historical averages, which is a good sign. So, uh, being on the pessimistic side of things at this point of time on this chart, I was able to see this from Ned Davis research firm. They released this chart. Let's see. It is even up to February 28th of 2022, next month. So this is their model, global recession probability model for Ned Davis research. They are now seeing a recession probability occurring at the start of February. Would you believe that? Well, we just got out of the lockdown. We just reopened, and the Wall Street firm now sees a possible recession up ahead. So definitely not a good sign now that the Fed is trying to tighten up March. Any thoughts, Wally?
Well, we don't know how much the Fed will raise the rates. Um, so initial reaction probably would determine, well, the initial rate hike will determine
Mhm.
the market sentiment
Right,
for half of the year, I would say, since they're raising the rates in March. So whatever they do in March will determine what the market is gonna do for half of the year.
right.
And if it's too drastic, then the market may, you know, the sentiment may scare off a lot of these new investors and
Right.
may cause a, you know, may rock the boat, to
Right.
say, and cause more fear in the market.
So this lady's question of where's the bottom, we might not see it quite soon just yet.
Well, looks
Um,
like she already saw it, and she
so
just closed her eyes and
didn't want to see it anymore. So yeah, for the other indicator, a reliable indicator for sure for in our experience is this inverted yield curve. So whenever an inverted yield curve happens, this is a 10-year treasury yield and the 2-year treasury yield spread. So whenever that happens, an a recession eventually happens. So at this point in time, we're far off that negative, that red line right there. We're at 0.75. So I don't think, looking at my crystal ball, I don't think there's not going to be a recession anytime soon, despite the model right here is already indicating. So it's up to the feds. If they raise the rates, like you said, while we too fast, too soon, then we might see a problem near term. But Bill Ackman, the baby Buffett, he's saying that the Fed needs to shock the markets to regain its what do you call it, credibility, to control inflation. So it can be that this guy is just trying to propel a sell-off, which we already know what he was able to do with coming out on CNBC and rocking the boat and trying to like facilitate some sort of market reaction in his interview, which gained him billions, probably the best trade ever one might can just dream. So we'll see if he's short the market, and we'll see if what turns out to be the right call. At this point in time, I believe the Fed is more even focused on inflation now that the unemployment rate is coming to its critical or a target goal. So this is another chart, the financial conditions. which reflects the money markets, debt, and equity, and also shadow banking systems. So right now, believe it or not, it's even going negative. So as we were monitoring this Huawei, remember a couple podcasts ago, we were climbing, but we were in the negative territory. So it was slowly tightening back in October to December. But since December 10, it has now loosened even further, even despite the Fed trying to signal that they're going to hike rates. So I don't know what's going on, but it looks like it's somewhat of acting inversely with what the market is doing right now. So I would like to see it going down and then inversely affecting the market as as the conditions ease. Supposedly, there's more money supply to propel the stock market higher, but in this case, it hasn't done so. But I believe it's also the case back in October to December. So it has been tightening from October to December, but the market still went up, and except for November. November we saw a lot of sell-offs, right, Wowie? Was it November? And then we
I
came
think
back
so.
roaring December. Mm. So,
Well,
go ahead.
the job market is still tight,
Right.
and we still have high cases of Omicron,
Mm-hmm.
and we still have a lot of goods that we want to buy that are still not available.
Right.
And so we're just like waiting for this dam to open,
Mm-hmm.
this dam to burst. So
Right.
right now there's a lot of, you know, um, people shorting the market,
Mm-hmm.
playing the wave in the short term, and then we'll see it. There's a potential for it to move way up
Right.
if the fear sentiment is corrected.
Exactly.
Yeah.
Right. And with the easing of conditions, if the Fed changes any tone from being like solid stance on hiking rates, then we probably might see some relief in the markets. So this is a Seeking Alpha article published on a weekly basis, which helps us track down in addition to Bank of America's fund flows. So it says here investors add 3 billion to equity and fixed income funds while withdrawing nearly 6 billion from ETFs. So money market funds, which are like almost considered as cash, saw 58 billion in withdrawals. Equity or stock saw 2.4 billion withdrawals. Taxable bond funds saw 371 million in withdrawals. Tax exempt bond funds suffered 239 million. Looks like each and every fund saw like an outflow last week. Everybody was selling, clearly supportive of that chart that we saw. The bearish sentiment of individual investors, lowest as it have been in the past decade, surpassing the COVID lockdown, believe it or not. So this is an article from the same, well, from Reuters, on the same, published on the same date. It says here, on a weekly basis, stocks, emerging markets saw the biggest weekly inflows since March 2021. So it's quite contrasting, interestingly. So different source, different data. So now we're just gonna take a look closely at Netflix. As you can see, what a dive from $506 Thursday. When it opened Friday, it dropped more than $100 a share to 399.43. Just imagine that crazy drop that just happened to its stock. Very panicking. So, like what we had said, Netflix stock plunges as subscriber growth worries deepen. So Netflix was expecting somewhere, let's see, 8.3. So Netflix added 8.3 million worldwide subscribers during its last quarter period, October to December, about 200,000 fewer than management had forecast. And Netflix also projected increase of 2.5 million for the first 3 months of this year, was well below the 4 million that Wall Street was expecting. This resulted into the sell-off. So if we're going to look at its financials at this point in time, which is for me the better reflection of the company's true colors, or what's underneath its sheets. So for December 2021, it had generated, for that quarter, it generated 7.7 billion in sales compared to 6.6 billion a year ago. So it added 1.1 billion in sales, and then its profit rose to 607 million from 542 million dollars a year ago. So not so bad in terms of its income. It was able to at least improve its income regardless of its subscription problems or hardships. If we're going to look into its financials, your balance sheet, I guess it's taking a little bit of time. Cash for Netflix is totaling at $6 billion, while its total debt is $17.9 billion. So quite a difference. It'll still owe 11.8 billion after paying all of its debt with its cash right now. And in terms of its valuation, it's not a pretty sight for its valuation. If we're gonna look at its 1-year history, it's now at its lowest in terms of its price to earnings ratio. I'm not saying it's a good time to buy, but what do you think, Maui?
Well, I would watch it and see what the CEO is going to do,
Mhm.
because Microsoft is into gaming and into media streaming too.
Right.
I think they just need to diversify into gaming. They need
Mhm.
to increase their games. And I don't know if the CEO of Netflix is gonna change his mind about advertisements, right? He doesn't like any advertisements, but
Right. Totally
it
against it.
may look like he may need to look into that, right?
Mhm.
To diversify his earnings.
To add more revenue. But the thing is, I think he's solely focused on no commercials, quality movies. He's even spending more in Korea now that they were able to break through with Squid Games. So I think the games for sure. It's quite promising now that Microsoft is involved, like you said, with Activision. There might be even more mergers and acquisitions in that field, as I have heard in one of the reports, but we'll see. So now we're going to jump into our Roll the Clip segment. This is Jeremy Grantham. He's the one who we quoted early last year, midsummer last year, about him predicting a recession back that time. So this has been viewed by 74,000 times. The title is Jeremy Grantham says the Fed cannot stop the stock crash. Very bearish. Let's roll the clip.
Trend line being slightly generous is 2,500. And most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the Nasdaq came down 82%, which was very brutal. Amazon came down 92. But the Federal Reserve braced to the rescue so loudly and strongly that they stopped the decline in the S&P at trend. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect, even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining to that level.
So he's saying that the market, the S&P 500, can decline to 2,500. So that's like half of the current levels of the S&P 500. If you're going to look at here, we even hadn't had 2,500 since back in 2017. So he's saying that the stock market has a potential to drop like that. What do you think, Wapi? It's an incredible call.
Yeah, I thought it happened in 2020.
Oh, yeah, right.
Yeah, then
Oh,
it
yeah.
dropped down to half in 2020, March of 2020.
Yep, that's right. So from 2020, it dropped from a high of 3,380 to low of 2,300. Okay, yeah. But since then, the S&P 500 is able to double. So he's calling for a drop to 2,500 again. Not seen since the COVID lockdown. Oh, that's far worse. You think
Yeah.
that's possible, Wawi?
Well, anything is possible, but that the trajectory of recovery would be probably less. Don't expect the S&P 500 to double just like it did 2020, 2021,
Mhm.
because there's no more QE.
Right. If there's no more QE, because hopefully they change your mind, but we'll see. But if they didn't change your mind, then we're probably gonna see home prices at $500,000 and relentless inflation. So the Fed is quite on rocky ground right now. So this is another clip from Bloomberg. Is it time to buy the dip? 37,000 views, 37,514 views. Let's roll the clip.
I think that we may focus on over the next few minutes is what is happening with the S&P, which is in and around its 100-day moving average. And that has been a great signal of late for dip buyers to come in. The question is this time different? But the question of the day is a fairly straightforward one. Is it time to buy the dip? Joining us now to discuss this, Eddie van der Volts of Bloomberg Markets Live, Abigail Doolittle joining us on set as well. Eddie, let me start with you. You wrote a piece that caught my eye first thing this morning. Cam's kind of followed that up with a whole load of other charts as well. This 100-day moving average has been a great signal. Is it going to work this time, or is this time going to be different?
Look, if Cam tells you today is a day to take your nose out of the spreadsheets, then you know it's a big day in markets. And really, I think it's been building up towards this, right? Because there's been, as you say, the year has just started off on this slightly tentative, slightly confused note with stocks pulling back, bond yields pushing higher. But every time over the past year, so really since the end of 2020, every time either we saw the 100-day moving average, or we saw stocks pull back about 3 to 5%. That's where the dip buyers came in. But here's the thing. If you don't see the dip buyers step in on these levels, if you see the 100-day fail, and you see the pullback going maybe to 6%, which we haven't seen for more than a year now, if we see those reliable indicators starting to fail for the levels at which the dip buyers come in, then I think it could turn really nasty. But it doesn't look like today is that day. It looks like today they're happy to come back on the bid again.
All right, so Abigail, obviously it's the 100-day moving average we're paying attention to with the S&P. With the Nasdaq, it actually breached that 200-day yesterday for the first time, and I think 439 trading days. How significant was that move?
It's interesting, Kaylee. That is a tremendous test of support, of course. But I think that when we talk about these technicals, and I say this as somebody who loves the charts, we want to consider this all from a macro perspective. And what we have going on here is a real repricing of risk. As the Fed tries to normalize policy and the other central banks, it's a time when you're going to see, obviously, yields go higher, and that jitters for all the different asset classes. That's a long way of saying lots of volatility. So if you take a look at the S&P 500 over the last couple of months, it's been going up and down, testing that 100-day moving average. Now, yesterday I was sharing with you and Guy that one of the old trade sayings is buy the first test and then sell the others. But this 100-day moving average on the S&P 500 has been very reliable. The fact that you have the Nasdaq down on its 200-day moving average, the Russell 2000 has been flirting with with its 200-day moving average all year. That does say something that there really is a war here between the buyers and the sellers. It's going to take time for investors to get comfortable with the idea that rates are going higher. Last year, if you recall, you had that 10-year yield back right up to 175, and then it caused a lot of jitters. Then investors got used to it, and then you had the Nasdaq 100 up a lot higher on the year. So I think volatility is the name of the game here.
And again, as you say, it has been rates that have been moving the equity markets. We've seen a huge repricing, a massive repricing at the start of this year in US rates. Any indications from the chart whether that move is over, how much more there is still to come? Because equity markets are going to take their cue from that.
They certainly are, Guy. And a very quick look at the 10-year yield, to my eye, would suggest that we're going to see 225 pretty quickly. Similar to last year, you had that 10-year yield. Once it went through 1%, it just took off for 175. These moves go further and longer than you could possibly think. So I would not be surprised to see the 10-year yield, that benchmark yield, go again above 2% really very quickly. That could cause the jitters that we're seeing. Think of this as a car. In terms of normalization of policy for the Feds, it's almost like a car stuck in a ditch. It's not going to be straight up. It's back and forth. Now, the yields, they could go straight up, but they're going to cause that back and forth for stocks. So I think, again, volatility as this repricing happens could be here for much longer than would seem possible, perhaps.
Well, Eddie, talking about how long volatility may stay around, it now seems like it's the March meeting and traders now pricing in more than a 25 basis point hike. Is that realistic in your view, and how would the market have to play catch up to that?
You know, I think the market really has come out and really got behind the Fed narrative of a really hawkish year with several rate hikes. I think, you know, even maybe 4 this year from the Fed looking possible if you're looking at pricing. The real question for me, though, is if we do see a significant sell-off in stocks, and we see, you know, there's nothing. Abigail's right. You know, the charts are only important as long as they support the fundamentals. But again, nothing changes the narrative like the price. And if we see a big drawdown, whether the Fed will say, okay, hang on a second, maybe that hurts sentiment too much, and we pull back a little bit on our, on our expectations of a hike. I think really the Fed has given itself a lot of room to be dovish this year, right? And I think throughout the year, perhaps they scale it back just a little bit if inflation allows them to do so. And that way, the Fed can come in, you know, through the end of the year, deliver 2 rate hikes, look dovish, and we see a very supportive environment for the equity markets.
That's a bit further down the road. We've got to deal with maybe the hawkish story unfolding a little bit further, Eddie. We're looking forward to that March meeting. I think there's a lot of concern around what is going to happen there and what the Fed is going to signal. We're in a quiet period now. We're not getting much commentary coming through from the Fed. You spoke this morning in your piece about the idea that there could be other catalysts. We've talked already about what is happening with yields. We've talked about what is happening with the charts. We've got the earnings story coming through as well. How are the dip buyers going to be looking at what is happening with the earnings story? Because the financials were meant to be one of the big areas that took advantage of the story of rising yields. However, we've had this flatter curve, which has unnerved them. We've got rising costs. Margins are being called into question. Eddie, if we're looking for other catalysts, if we're trying to think about what is going to encourage or discourage investors in the equity markets, the dip buyers, whether they come in or not, how important are earnings going to be?
Earnings are really important, but earnings are a little bit backward looking. And don't forget, we had Omicron and, you know, this wave of infections that around the world that affected supply chains again and so on. So it's a little bit backward looking to me. For me, what I think the traders are going to care about are the anecdotal stuff, right? The commentary that comes alongside the earnings. What the CEOs, what the executives tell us they're expecting for the quarter going forward. Of course, that is always important, but the same for PMI and the beige book. Those are the 3 things that I'm really looking forward to tell me where we're going from here, because I think the backward-looking stuff, I think Christmas was a little bit cloudy this year.
All right. So for the girls, she said it's going to be volatile. I'm not sure where it's going to be at, but there's going to be a relief later on, maybe. Hopefully, if the Fed takes a dovish stance after being hawkish throughout the year. That's what I understood. What do you think, Wawi?
Well, a lot of these hedge companies are already set foot in, like Japan and China,
Mm-hmm.
where they're already starting their early cycle,
Right.
of recovery.
Mm-hmm.
Some analysts here in the US thinks we're in the mid cycle still. So it's gonna be a slow thing for us. So if you just watch where BlackRock and you know JP Morgan is putting their assets,
Mm-hmm.
they're putting it where, in Japan, in Europe, right?
Emerging
China.
markets. Yep.
So that's where it's growing faster, you know. So when they start shifting their focus away from those areas, our economy is improving.
Right. I think right now with the tightening hawkish stance, we might be already in that kind of like not peak, but probably close to it. And like you said, China and Japan. China just did another rate cut instead of rate hike just last
Yeah.
week. So that's something to look forward to. It means that there's some slowdown happening in China since we have observed a couple months ago. So central bank over there is doing something to facilitate economic growth. So everything is up in the air right now, and last thing that we can do is just hold on and make sure we have enough conviction in holding our stock investments over the long term.
Well, wouldn't you be surprised if the Fed says they're just gonna raise the rates one time this year?
That could be a very bullish and probably, well, the problem is some of the people or Wall Street would think that they're probably going to be running out of credibility if they did that, as they won't be able to fight out the inflation. But yeah, that would be nice. I mean, we might see more all-time highs.
Maybe
It's
one, maybe two, right?
yeah, two rate hikes. Well, before we end, Wowie, do you have any quote for the week?
I don't have any quote for the week, but I know if you're taking care of a baby, make sure you burp the baby.
Burp the baby. Hey, congrats, grandfather Wowie. Well, thank you for the quote, Wowie. And we surely need to take care most of our family. I mean, if not each and every one, as much as we can. Allocate time to family members and your loved ones. And stay healthy, Wowie. Thank you for coming on on this episode despite a late notice. And I know you're still recovering, but hopefully you get to feel 100% soon.
Yeah. Well, thanks for the vaccine. I think I'll be up and running here in no time.
All
I'm doing
right.
better already. I think it took me about, maybe 4.5 days to start feeling better. I
Wow.
just needed to get out and get some sunshine today. So I went out to the shooting range today, and that
Right.
made me feel a whole lot better.
Mm-hmm. It just reminds me because right now in my work, like I also work on weekends in the hospitals, and I've been seeing new influx of COVID patients. It feels like somewhat of December of 2020 when we had it very worse at that point where we still wear the hazmats and all that. But at this time, whenever I try to do my subjective information or gathering, most of these patients are unvaccinated. So if you don't have the vaccine, it's not like I'm promoting to get the vaccine shots, but it could help for sure. Like, right, Wowie?
Yeah, well, I'm pretty sure it helped me a lot.
For sure. Yes. Well, Wowie, thank you so much for coming on this evening.
Yeah.
Listeners, that does it for this episode of Mark Yu and Wowie Show. If you have any questions, send it over to markyuwowieshow@gmail.com. Remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark Yu signing out.
And Wawi Santos, hang tight.